Good afternoon, everyone. Yes, I'm Henry from Beauhurst. Beauhurst is a data company that tracks the UK's economy with a particular focus on all businesses that innovate or grow. And as said, I run our consultancy unit. We have data on every single company in the UK, but I identify the innovation economy by looking at the businesses that receive equity funding, spin out of universities, receive innovation grants, win patents. Any signal that we have that the company is innovating or growing or has the ambition to at least do those things. The bit of data that I'm going to talk about most today is that investment piece. So we look at every single investment deal into every UK company. To get immediately quite technical, the category that will be the sort of bedrock of my analysis is primary minority equity. So that is everything from angel rounds, VC rounds, all the way through to PE, where it's growth PE and not buyout PE. And we track those companies through to death or exit or whatever the fate of the business might be. So we've got a view of the UK economy that comprises 5.5 million private companies. But within that, the innovation cohort subset is around 60 to 70,000 companies, depending on how you define that. Within that, just over 31,000 since we started in 2011. Just over 31,000 have raised external equity finance in order to grow. That means we've tracked nearly, soon it's ticking up every day, nearly 90,000 deals worth almost £240 billion to the private companies in question. But the median deal size that we've been tracking is 280K. For a long time, that hovered around 150K and 250K, clinging quite closely to the SCIS limit, representing most companies' first rounds. In recent months, it's gone up a little bit, but basically it tells you that the median deal is also the first deal for the companies in question. So the hurdle rate to get on to later stages of financing is quite high. The reason why this is the data point that I'm going to focus on is because it's a signal of health, or depending on what direction the data is trending in, signal of health or otherwise in technology sectors. It is the main mechanism we identify by which new technologies come to market. Not the only one. Spin-outs have a place. The role of Innovate UK, especially in this sector, Innovate UK and other non-dilutive funding is hugely important. But by focusing on private minority equity investment, we can get a real health check on various tech sectors. We're completely sector agnostic. That means I am also completely sector agnostic. I know there are some great sector experts in the room. That's not why I'm here. I'm here to tell you what our data tells us about the national picture of these on this sector. But I'm going to start by talking about investment volumes overall into all UK companies. So the trend was starkly one of growth heading into the pandemic. The line here represents deals, and the bars represent the cumulative value of those deals, the new money into the underlying companies. We go into the pandemic period, see some huge spikes, a lot of reasons behind that, and now we're in a period of retrenchment, correction, downturn. Choose your euphemism according to how you feel relative to the market. A key point to make about this graph overall, like a lot of this is tech, doesn't have to be, but because it's primary minority, a lot of the underlying companies are tech. We present it, I'm presenting it now, as a homogeneous asset class, because the mechanism of the money in is the same. However, the types of investors and the types of investees are wildly different under this graph. So there's an argument to be made that actually we need to try and separate out the different asset classes. To sort of illustrate that with some examples, a £1 million deal into an AI MedTech company that we'll come on to talking about later in the day is completely different to, say, £100 million into an e-grocery delivery company. Completely different in terms of what the company will use that money for, completely different in terms of who put the money in, and indeed even completely different on the basis of why they put that money in. Yeah, in those, the reason I use the e-grocery delivery company is because some of those deals are what caused the pandemic spikes. You had very new types of investors coming into the market, people who didn't look at all like a traditional deep tech venture capital investor. Their interest in the market, well, some of them were actually hedge funds and they behaved a little bit more like hedge funds. Their interest was more in the price of the assets rather than the value of the assets, whereas venture capital is sort of more fundamentally a type of value investing. But in the pandemic period, with money printing going quite wild, basically value and price, even in these private companies' assets, became unattached. And so a lot of these investors saw an opportunity not to create fundamental value in the underlying companies, but that you could get in and get out at a price on the right trajectory. Those investors have left the market by and large. You know, the one that was closest to it, which is still around, is SoftBank. A lot of the other ones, Tiger Global, much less active than they were in the pandemic, and there are other examples as well. So that causes some of your retrenchment downturn that you're seeing in this graph. And I hasten to point out that, you know, at the quarterly level, you're still seeing, you know, not in quite a few of the recent quarters, more than £5 billion into these companies. So to probably understand this trend and what it means for the MedTech businesses in the room or your clients that you're working with, we need to look into it a little bit more detail. I will start with the good news. So this graph, same as before, the line is deal numbers and the bars are amounts, is showing first-time fundraisings. So the companies that are new to market raising their first round of external funding. Another way of thinking of that is the prospective pipeline for investors further down the line, VC investors and growth investors. And for a long time, we'd been observing, you know, from the pandemic peak, a pretty stark downwards trajectory. This is the supply of new ideas into the market, is another way of thinking about it. So quite happily, we see quite a pronounced bounce back in the very final quarters. New ideas are coming back into the market and getting their first round of funding, creating more competition further down the line, certainly, but at least, yeah, this tech landscape where it's funded in this way is the vehicle of Schumpeter's creative destruction. If you don't have new in at the top, then you don't get that creative destruction, you just get stagnation. So it's really good to see that coming back. Huge factor in that is AI. Won't surprise anyone, but these are the companies that have allowed money to flow back in despite some real systemic challenges preventing money from reaching companies, which I'll come on to with this slide. This is arguably the bad news. Depends on which companies you're working with and what stage they're at. Basically, particularly for the benefit of people at the back, the top line is showing your net population, sorry, your total, not net, your total population of companies that have raised this kind of funding, have joined the funding ladder, are tech companies that are looking to scale, basically. And we're at a record level. Net companies is that same number, just net of deaths and exits. So although its growth is tailing off, we're still at a record number of net companies. These are companies that are still alive, looking either for subsequent rounds of financing or for their exit. And indeed, it's only actually cooling off because the cessations rate is going up. All of this is just a way of describing the liquidity crunch that the whole tech market is currently facing. There just isn't enough, particularly secondary capital. The reason why I was saying primary so many times at the front, at the beginning of the presentation, particularly secondary capital, there isn't enough secondary capital in the market. That means the whole system is gummed up. angels are stuck in early stage companies, VCs are stuck in companies. Those VCs, LPs, can't put money into new funds. The angels can't do new rounds. And even to an extent, founders are kind of stuck in businesses that aren't meeting the growth trajectories they'd hoped to. The mechanism for a potential solution is, well, the main route to exit for companies like this is through sale to another larger UK company. We read, when a few of them happen, we read about IPOs and they get a lot of airtime. Sales to foreign companies get a lot of airtime, tend to be larger transactions, but also there's all of the political commentary that goes alongside around sovereignty and loss of technology on that basis. And indeed, there are a handful and an increasing number of PE sales. So when I say exit here, I'm meaning the sort of first exit from founder to next owner, not PE to PE. That's an increasing proportion, but broadly 7 out of 10 times when a tech company exits, it is to another UK company. And so would you right now, I heard there was some conversation earlier about what might be happening in the budget at the end of this month. Would you right now, if you were in the, maybe there are some corporate strategists in the audience, if you were in the corporate strategy team of a business in any sector, but particularly a tech sector, would you be feeling now is the time to get out your checkbook and start cutting some deals? Possibly, if this problem only gets more acute, you might be able to command a better price than you would have got previously. But nonetheless, I think there's a real dent in. We only need to read any of the surveys to see that there's a dent in sort of business and corporate confidence. And until we see that change, this graph is probably only going to get a bigger problem for the overall tech sector. So that's some spiel about tech and funding overall. I've now looked into some of the sub-numbers for MedTech. I reiterate my caveat, I'm not a MedTech expert. I'm a sort of financing and innovation guy. Shameless plug for some research that we did earlier this year with Pioneer Group. This is showing the rate of all life sciences, so life sciences plus MedTech, the whole sector, the rate of new startup in corporations. And basically, it's following, this only goes up to the end of 2024, so it's following that same curve we saw around first-time deals. So I think when you look at this, I don't think it is a life sciences specific trend. I think it is part of the wider UK macro issue. And hopefully we'll start to see the same recovery in those first-time deals that will affect that graph whenever we next cut it. This is from the same report, looking at equity investment into all life sciences plus MedTech. You can see again a pandemic effect, particularly in the amount, more noticeable in the amount invested, less of a pandemic effect in the deal count. So like slightly more stable growth, and a bit of a dropping off in the number of deals. Sorry, at the back, you probably can't see that very well in the back, but it is showing that the number of deals dropping off, whilst the amount actually climbs a little bit into the end of 2024, which is when that graph goes up to. Zooming in to look at MedTech, and again, caveats about where the observation period here ends and where the axis starts. So don't worry, that's not for the line, that's not it trending to zero. It is trending very close to 2016 levels, but 2025 isn't finished yet. But the amount presenting quite a challenging picture, basically. It's just not as easy to get funding in this sector as it has been previously, with some exceptions. So this graph, now looking quarterly and looking at the overlap between MedTech and AI, so companies in MedTech with some element of AI either in their solution or in their discovery mechanism. And Q3 was a record all-time quarter for those companies, and not driven solely by one overarching mega deal, but by a handful of quite large deals. And again, don't worry, that final observation period is the current quarter we're in. So one bit of optimistic news on the funding landscape, particularly where it comes with AI, and again, much related to that previous graph I showed where the recovery in first-time deals is purely driven by AI investment opportunities. To come back to a point I meant to make when I was talking about the liquidity crisis, one of the reasons why that's a relevant factor in say this, or another way of thinking about it is AI is allowing even those investors who are facing a serious liquidity crunch to invest. It's such a clear and present need to have some of this in your portfolio that you sort of find whatever resources you have to invest. You probably hear a bit about talking about less and less these days, but trying to defend the sort of levels of VC activity that we could see some recovery because of dry powder. But that dry powder is all tied up in that previous graph. The LPs have made commitments on paper that they are struggling to meet in cash terms. But where AI is involved, many more people are piling in. It's my final slide. It was just to illustrate that point about that final quarter not being driven by just one mega deal, but actually quite a bit of activity. So in the likes of CoMind and Chemify and Cyted Health, those are all really sizable deals that happened in the quarter, just the calendar quarter just gone. So certainly, I was trying to work that up into not ending on too gloomy a note. In this sector that you're all here to talk about, there is actually some very positive news. The backdrop, the headwinds for tech overall and innovation financing are really challenging at the moment. There are a few other sort of promising things to try and bring more liquidity. A lot has yet to be seen still about Pisces, but that would hopefully bring, if it can be made to work, bring some liquidity to these kinds of companies. But as I said previously, the sort of attitude and feeling of corporates, UK corporates, is probably the key to unlocking more funding for the earlier stages.